Us started, guys. So I'm Jason Collada with the Midwest Food Products Association, and I'm very grateful to have the opportunity for APPI Energy to put on this webinar today. With the volatility that we've been seeing in energy markets and the industry having to deal with ESG and what does that mean for complying with these new proposed standards. I actually reached out to APPI and asked them to put together a little session for our folks, something that we could share with our teams. And I'm very grateful for them doing so today. I also want to acknowledge Michael Lewis and Bailey Moses, who had come to our convention this last year and really got a chance to meet a number of our folks and just begin the conversation about how APPI can be helpful with a lot of the energy challenges that our members are facing. So Dan, I think you have the floor. We'll let you get started.
All right. Well, thank you, Jason, and good morning, everybody. Thank you very much for joining us today. Sorry for a few technical difficulties there, but I hopefully we've got those mapped out. I'm going to go ahead and keep the presentation in this mode, so just so we don't run into more difficulties. But what we really wanted to do today, and again, really proud of our work with the Midwest Food Processors Association. But what we were hoping to do today is, again, just tell you a little bit more about what's going on in the energy markets, what maybe the impact is to your organization, and what you can really do about it. Are there ways to mitigate some of these costs? Trying to understand a little bit more about the impact not only for competitive suppliers. Many of you are in deregulated electricity and natural gas markets, where you actually have a choice of who provides the energy, but not everybody is. So we wanted to talk a little bit about utility prices and kind of where we see utility prices headed. Again, a little bit about strategies for reducing your carbon footprint. Jason mentioned a little bit about some of the proposed ESG requirements coming. Talk a little bit about that, and then maybe just some next steps, some things you might want to do for your own organization. And certainly we'd be happy to help you and answer any questions you may have. So without further ado, we're going to talk a little bit about what's going on in the energy markets. Easiest way to look at that, it's kind of a painful chart to look at, but what you see here is really a 5-year look back for both electricity and natural gas prices here in the United States. The orange line is natural gas at the Henry Hub spot pricing in Louisiana. And then the blue line is our sister organization, the Energy Research Council. They take all the offers that suppliers put into the market every day. We have literally millions and millions of data points based on real world offers that suppliers put out into the market. And we track those. That allows us to kind of, hopefully answer two questions. Is now a good time to buy? And how long should I buy for? But looking backwards, one takeaway you'll see from this chart we think is really strong is the correlation between electricity and natural gas prices. We often say when natural gas prices move up today, power prices are going to move up tomorrow, and the converse is true. So electricity, not necessarily quite as volatile. You see some various spikes here. This big one here literally went off the charts, was Winter Storm Uri in the mid-continent last February, where natural gas prices only for a few days, but absolutely took off and literally went off the charts and set new records. But really the bigger trend, so you don't see that big jump in electricity, but the general trend, natural gas moves up, power prices move up. When you see a dip, and on gas, you see it on power as well. So strong correlation here, and obviously you can see the trend. Both commodities have really moved significantly higher. Just to delve into a little bit more on the natural gas side of things, folks don't necessarily buy on the gas on the spot market for delivery today, cash prices for today. They generally buy a strip, and that's oftentimes a 1-year strip. So we track that as well. And if you get some historical perspective, where was that 1-year strip trading in 2019 and /2020? Where was it in 2020 and 2021? Where was the 5-year average? All of those that are down here significantly lower than the black line, which is year to date, basically about the last 6 months for natural gas prices for a 12-month or 1 year strip of natural gas. And again, the 5-year average for that has been 288. Currently this year, it's around 660. So a really dramatic run up. And again, some of the things we're going to talk to you today is, tell you a little bit about what's going on, but more importantly, what can you do about it to try to mitigate some of the impact on that? So what's driving it? What's really driving those prices? One of the big things you look at, good old supply and demand, right? When we talk about supply, many of you probably know that as a country, for about half the year, we extract natural gas out of the ground, and then we put it back in the ground in storage, whether it's big salt caverns or old wells. So storage levels, that's really a measure. Every Thursday, the EIA, Energy Information Administration, comes out with the natural gas storage report, and that gives us an idea of how much gas is available for really for next winter primarily. So we're entering into the injection season where we pull it out of the ground and then put it back into storage to get ready for next winter. As you can see here, compared to the 5-year average or where we were at year to date last year, we're significantly lower as a country than we were against either of those metrics. Again, the 5-year average or where we were last year. So what you're really seeing here, the red line here, is significantly lower than the blue line, which is the 5-year average. EIA does a forecast of where they think storage is going to go for the remainder of the year. And you can see here, again, we're really near the bottom of that 5-year average. So from a supply standpoint, that's certainly something that's driving prices up. Now we look at the flip side of it, production. What's production going to do? How much gas can we expect to pull out of the ground? We look at some historical perspectives, again, the last few years. And then we see the dotted line here is EIA. It's the government's forecast for where production would go this year. What you see here is they said, well, we think it's going to keep climbing throughout the end of the year. And normally higher prices do exactly that. They incent more folks to return to the fields and put new rigs in the ground. That isn't really happening the way that it has in the past. In 2016, it was the old drill, baby, drill. We're just going to keep putting more rigs in the ground. And the investment community didn't really care so much about returns. They just said, put rigs in the ground. We'll worry about the returns later. Now things have really changed. Wall Street isn't really excited about fossil fuels. Natural gas is still a fossil fuel. They would rather invest in renewables and in green energy. Even at today's higher prices, we've got supply chain shortages, we've got worker shortages, and a general reluctance to go invest more in fossil fuels. So production has not come around the way that you might have expected it to when you see these very high prices. So that's kind of working against us as well. But again, for the forecast for the year, production, EIA still thinks production will slowly climb. This next one is probably the biggest. We'll go ahead and let Peter in here. Sorry. This one right here is probably the biggest driver we're going to talk about today of what's driving natural gas prices in the U.S. Although $7, $8 gas is extremely expensive, relatively expensive here in the U.S., it pales in comparison to what that same gas can get overseas. So what we see here is a chart of where LNG, liquefied natural gas, if I cooled natural gas down, ultimately it turns back into a liquid, a very stable liquid. I can put that on a tanker and I can send that over to Asia, or I can send that to Europe. So although it's great that I can, if I was a gas producer, $6, $7, $8 gas here, that's attractive. But boy, if I can get it on a tanker and get it over to Europe, I can probably get $30, $40, $50, $60 premium over what I can get here. That is having an impact in the fact that it's keep making demand very high and keeping demand high for the foreseeable future. As a country, we really can't export much more gas than we currently do. Unless some additional terminals get online. But there's 7 operating LNG export terminals right now. There's 12 in the pipeline. They won't all get built. They won't all get approved or financed. But the reality is as a country, we're continuing to move more towards being able to export more natural gas overseas. So although it's very expensive here, that's keeping demand very high because it's a real premium. And so for our friends in the New England states, in the winter they actually import LNG as well to keep residences and businesses warm and toasty in a cold Massachusetts winter. So they're competing with these LNG prices nationals as well, international prices. Just to kind of give you a quick look back as to kind of how things have changed over the last year. Again, EIA, Energy Information Administration, every month they put out their short-term energy outlook. And we often talk about saying, okay, this is kind of your upside risk, and this is kind of your downside benefit, right? So looking back May of 2021, they said, the government said, hey, we're 95% sure gas isn't going to get over $6. And we're 95% sure it's not going to get under $1.50. But where they really kind of thought it would be for 21 was right around $3 and then bump up for this past winter and then come back down to $3. And the market basically said that as well. In fact, NYMEX actually said, no, we actually think 2022 is going to be down back around 250. Well, nobody's got the crystal ball. We don't either. And the government doesn't, because fast forward to 2022, they had to get a whole new chart. You see that the high end now is $35 as opposed to $7 an MMBTU. And now the government says, well, we're 95% sure gas isn't going to get over $30. And we're 95% sure it's not going back under 250. Where it's currently trading right now is right around that $8 range, really, for the remainder of this year, with some forecast of it dropping down to around $5 for next year. Time will tell. Weather is absolutely the biggest driver for natural gas prices. Again, power prices follow natural gas. We'll see who kind of wins out here. But again, not great news for you folks in the short term. Natural gas prices for the remainder of this year are really expected to stay very elevated. And although we'll see some relief in 23, it's really not until you get out until 24, 25, further out terms, that you really start to see a significant drop off that can bring prices back down to earth. What's the impact? Some of this is probably overstating the obvious here. You folks are seeing it not only in the energy side, but all commodities, whether that's eggs, whether that's milk, gasoline, electricity, no exception. Inflation has really run rampant from a commodity standpoint. Our recommendation is generally to start early. Although prices are high right now, we don't really know. Nobody knows what they're going to be in 24. So don't wait. Again, I mentioned earlier, weather's the biggest driver. Doesn't mean you lock in today, but what we recommend for those of you who can take advantage of deregulated energy markets and shop for a supplier, don't wait till the last minute. And a perfect example of this I often refer to is again, that Winter Storm Uri last February. Imagine you were an electricity buyer in Texas and your contract ended in March of 21. And you said, call me in February. That's when I'm going to look. When the market took off, you really had no option. You didn't have the ability to wait for the inevitable dips in the market. So what we say is a year, even as much as 2 years in advance, start testing the waters, get a benchmark of pricing, start to look at supplier contracts, whether this is true for both electricity or natural gas. Don't wait till the last minute. Doesn't mean today's the right day to be a buyer, and it very well may not be given the conditions that we're in, but you've got time. You get a trusted energy consultant, can monitor the market for you, maybe put some target prices in effect and help you buy on those dips. Also, for not waiting to the last minute, utilities and suppliers to have different requirements. And you may come up to the end of the agreement and say, okay, well, it ends in March. So in March, I'm going to, I'll make a decision. Well, Maybe that supplier has a requirement that you needed to let them know 30 days or even as much as 60 days in advance. And then all of a sudden you are exposed to market conditions. So again, not waiting till the last minute is our advice. Prices do get more volatile. Again, I mentioned that before. We don't know they're going to be higher or lower in the future, but we know they're going to be more volatile because they're more subject to weather. So again, get out ahead of it. And this volatility, we've been in business since 96. These are the most volatile natural gas prices we've seen in our entire 25-year history. Volatility can go either way, though. Lately, it seems like it's only one direction. It's only heading up, but volatility means it can, the swings. So again, start early, have somebody monitoring the market for you. And when you see those dips in the market, you're ready to grab them, as opposed to, oh boy, maybe now's the time I got to start shopping. Our holistic approach, and I'm going to turn it over to Michael here after this, is really the idea of how can we help you if you can take advantage of deregulated markets, how can we help you buy at a lower cost for electricity or natural gas? But then taking one step further, how can we help you reduce your usage? As they say, the cheapest kilowatt hour is the one you don't use. Can we help you reduce some of that? Can we help you become more sustainable, more efficient? And that's really the balance of our presentation. Michael's going to talk about some of our steps around efficiency and sustainability. And again, just the idea of a trusted advisor. We're really proud to work with Midwest food processors, and about 160 other associations have endorsed us as their exclusive energy consultant. We're not the only game in town. Find someone that you trust, find someone that is going to look out for your best interest. We'd love it for it to be APPI, but having someone who is focused on the energy markets day in and day out. We live, breathe, and sleep this stuff. We're on about 400 RFPs every month. So we really think we've got our finger on the pulse of the market and can help our clients make well-educated buying decisions. So with that in mind, Michael, I'll continue to drive the slides if you wish. And if I don't pick up on when you're ready to go to the next one, just nudge me and let me know. But thank you all for your time, and we'll have questions at the end.
Thank you, Dan. Great job. So we're going to get into a few different things here, and I wanted to start by kind of piggybacking on what Dan was saying about the rises in cost of electricity mirroring the gas markets, and what that's going to do to your cost of electricity. So looking at ways to reduce costs of utilities, electricity and gas. Speaking of electricity, demand charges and time of use charges, we feel like are going to become more and more expensive. And some of the technologies we're going to focus on here in a minute are ways to reduce some of those time of use charges and demand charges. So understanding what demand charges are and what makes up peak demands, avoiding any coincidental peaks. This is something that you're already focused on at your facilities. And we believe these charges, these time of use charges, are going to become more expensive. I was looking at these states individually and looking at the electricity mix in these states. And while in Wisconsin, focusing, natural gas makes up almost 34% of the electricity mix in Wisconsin. Coal makes up 51% of the electricity mix. In Minnesota and Wisconsin, the other half of Wisconsin, coal makes up 38%. And in Illinois, coal makes up 61.5%. And I'm saying that because we've also seen, with the rise in electricity costs because of the rise in the natural gas that Dan was speaking of, coal is up 400% over the past decade. And most of that increase, in March 2020, coal was trading at $34 a metric ton. Today, it's over $300 a metric ton. So in saying that, these time of use charges and demand charges are going to be more important to avoid. We're going to talk, and I'm going to speak a little bit about sub-metering equipment and building energy management systems, and how to use those. Speaking of demand charges, there are a few programs that we work with to reduce demand charges and provide you a little bit of payback for reduction in demand charges. Those are called demand response programs. We're always happy to review individual facilities to reduce, to enroll in some of those programs. Large customers, you get an annual check or a biannual check for curtailments to a building's electricity load during hours of peak electricity grid demands. And these are typically the hottest days of the summer and the coldest days of the winter. And then there are other programs that are demand load management programs, which are also a great opportunity for any business. It's looking at ways to load shift where possible. Obviously, it's tough during working hours, but there are other ways to look at load curtailment during peak grid demand hours and lower your cost of your future capacity tags and transmission charges. So in saying that, this is just, your facilities probably aren't this drastic, but it just gives you an idea of how these demand charges work. And avoiding these peak demand charges, you can see right here, there's a huge amount of cost, and there's going to be an increasing amount of cost to peak demand charges and current demand charges. So avoiding these types of peaks is going to be more and more cost effective, and that's part of the other programs that I mentioned just a minute ago. So one technology that you may be implementing currently or you may be looking at are types of sub-metering equipment. So these are building energy management systems. It's a forensic energy management solution for a facility or any kind of building. So this is hardware coupled with these monitoring devices that provide granular, cost-effective, real-time analytics. So it provides this customized reports in real time to every kind of energy input you have at a facility. These provide real power, watts by equipment charts, so you can see where your demand charges are taking place at what time of day. You can set this up to provide cost reporting by each individual piece of equipment or by groupings of equipment. So you're giving yourself, you can just log in and you can give yourself a virtual energy audit at any given time in real time. You can't manage what you can't measure. And the point being to provide this type of equipment so that in real time you can see everything across the facility, cost of everything across the facility, and start to be able to participate in other types of programs where you can load shift or reduce some of your demand charges during different peak times a day. Performance verification of all equipment. You can identify power quality issues, and it's all cloud analytics, so cloud-based. So it's a complete energy data in real time, and it will equal major cost savings. Another strategy and equipment that you've probably looked at are, and if you haven't, start taking a look at it and take it very seriously. Different types of controls paired with variable frequency drive motors. So these match the speed of a drive to process requirements, matching the torque of a drive to the processing requirements, reduces the mechanical stress on these machines, extends their lifetime. So this leads to lower peak consumption, avoiding high coincidental peaks, avoiding and lower peak demand charges, and reduce motor sizes required for equipment loads, integrates network diagnostic controls to control and analyze the performance of this equipment, increases productivity, and automates manual processes and inputs. These motors typically run at full speed regardless to demand, so the VFDs contribute to savings of up to 40%. Intelligent motor controls leads to energy savings, and again, peak current reductions by matching the energy requirement to the driven equipment. So a big part of that 40% savings is part of that demand charge reduction. Another technology that you probably looked at that's definitely part of the savings on natural gas heat recovery systems with economizers and any kind of heat recovery system. So capturing heat from flue gas from boilers, turbines, ovens, dryers. It can be multiple sources of heat, typically captured in exhaust gas from boilers and heat processed water. Because of the price of natural gas, savings right now is 6 months or less sometimes. Natural gas prices are projected to remain high. I think we can all see that what's happening in Europe is going to continue to put pressure on natural gas prices in the United States. And as we've, across regions of the United States, decommissioned coal-fired power plants, as I mentioned a minute ago, a lot of the electricity mix in Wisconsin, Minnesota, Illinois are coal-fired power plants. Price of coal has gone up to historical highs. And while some of those are being those are in the mix to be decommissioned over the next few years, gas-fired power plants are taking their place, and we know that the price of gas will continue to stay high. The other technology that we feel like is a low-hanging fruit, LEDs. This is probably the low-hanging fruit of all of this. It's carbon reduction, but it's retrofitting all lights to LEDs is something that everyone should be looking at. There are still incentives in utilities across Illinois, Wisconsin, Minnesota, Iowa. Depending on the type of facility, this can reduce kWh, kilowatt hour consumption, by as much as 25%. There's also the additional savings from avoided maintenance and additional health and safety savings from increased visibility. This is an incalculable savings, but it should be considered. And as I mentioned, there are rebates and incentives that exist today in Wisconsin, Minnesota, Ohio, Iowa, and we're happy to take a look at those for you also. And big topic, everyone's heard about solar. Whether you've looked at it or not, that's something that we help customers with every day, is understanding how cost effective solar will be for your facility. The thinking traditionally is that solar isn't very cost effective in the northern climates of the United States. Fact is that federal incentives, now the 26% federal incentive, the investment tax credit, and also 100% bonus depreciation incentive, that gives up to 56% in federal incentives to go solar for year one. So if you're looking at a rough number, $100,000 investment realizes 56% tax incentive in year one. There are also incentives to provide solar if you're looking at financing it through a third party. We're happy to look at different financing vehicles if that's something that's of interest. There's also renewable energy certificates, and Ohio and Illinois have pretty substantial renewable energy certificate markets. That Ohio market includes facilities and solar production in states around Ohio. So you could be looking at Michigan, for example, is also able to participate in some of the rec market sharing with Ohio. So the big thing about solar and why it is so cost effective with these increases in electricity prices, it gives you an ability to hedge through the investment in solar. You look at historical weather models, plus or minus 0.5% what the production of the solar facility or solar project is going to produce year over year for 25 years. You're able to bank on that as a hedge for that cost of electricity that the solar is going to generate over that 25-year period. Solar will continue to produce electricity for much longer than 25 years. It's just that financial models for solar typically model it based off of the 25-year warranty period that most solar panels are held to. So, and speaking of solar and looking at larger facilities or hedging electricity costs through solar and wind for that matter, if you're looking at multiple assets or a portfolio of assets across different locations, we're able to look at virtual power purchase agreements. So this is where a developer will go and install they'll build a wind farm or a solar utility scale solar farm. And you're able to be an off-taker for the electricity for a certain period. Usually it's about 12 years for a wind farm, 15 years for a solar farm. You enter into an agreement for a fixed price of electricity. It's a contract of differences. So you're still paying for electricity you're paying your monthly bill to your utility provider. There's a settlement. So this is a purely financial transaction that the company obtains the renewable energy certificates and also a fixed cost of electricity from that utility scale solar farm or wind farm. And then there's a settlement period where you're paid the difference from what you've been paying to your utility company versus that hedged price of electricity from the VPPA agreement. So it's a way for multiple facilities to engage in solar or wind without having to physically install solar and wind at any of your locations. So we're happy to look at that. And obviously this meets a lot of sustainability goals quickly and efficiently. And we put together portfolios of different VPPA options, and we can speak to that if you're interested. Speaking of renewable energy certificates, it's another way for companies to engage in sustainability reductions without having to physically install solar or wind at any facilities. You can purchase, and we're happy to look at pricing for you. You can go to the market and we can look at pricing for renewable energy certificates and apply those against your benchmark carbon emissions, which we'll get into in a second. These are across the United States. Instead of paying for electricity from typical brown power, fossil fuel-based power, you can offset those power sources by purchasing renewable energy certificates on the market. And speaking of carbon emissions, maybe you're aware, or you probably deal with this already if you're part of the supply chains of Walmart or Target. But this idea of having to benchmark historical carbon emissions, the Securities and Exchange Commission came out a couple months ago and started implementing, or will start implementing, guidelines for any participants in publicly traded entities are going to start to have to show their scope 1, scope 2, and scope 3 historical carbon emissions. So scope 1 emissions, if you're not familiar, these are direct emissions, on-site generation, fleet fuel consumption, natural gas consumption on site. Scope 2 emissions, these are indirect generation of electricity. So heating, cooling consumed within the building, any brown power, any green power, anything that's being purchased by the building to keep the facility functioning. This is all part of your scope 2 emissions. Scope 3 emissions, this is going to be where it's going to affect any company that's dealing with a publicly traded entity and why it's being driven by, historically in Europe, the companies that have participated there and adopted some of those guidelines, like your Target and your Walmart. Now that's going to be adopted by all companies that are publicly traded across the United States. They're going to require of anyone who's participating in their supply chain, so their vendors, their suppliers, are going to have to present their scope 1 and scope 2 emissions so that that publicly traded entity can populate that as part of its scope 3 emissions. So APPI, we have a software platform where we populate all these historical carbon emissions, and it's an investor grade utility benchmarking platform for all carbon emissions. So you're taking all your utility costs, your electricity, your gas, your vehicle gas, your water, your sewage. It's taking all that and all your trash and populating it into one place, so that with a click of a button, if one of your partners asks you for your scope 1 and scope 2 carbon emissions, you have either, it can be a single facility, you can do it across all your facilities, all your assets. It populates everything so that you can in real time hit a button and send a report to anybody who's requesting this data. uses the EPA e-grid for everything in the United States. If you have facilities that are outside of the United States, it uses the IEA international data platform. So this is taking all of the scope 1 and scope 2 emissions, populating it through this platform, and it gives you everything that is being required by the Securities and Exchange Commission. It's based on greenhouse gas protocol adopted from the Paris Climate Accords. It's self-service emissions tools, managed care, and it can report by time period and benchmark by whatever time period of data that you're able to populate. So if you can go back, if you have all these utility bills from even 20 years ago, you can populate everything in there. Typically what we're seeing are companies populating it starting 5 years ago or 6 years ago, and in some cases avoiding or minimizing the amount of data from the year 2020 just because it was such an anomaly. So in that, what it does is it takes your data and populates your carbon emissions based off of the location of the facility or building where that data is coming from. And as I was stating a minute ago, Wisconsin and Minnesota share an area together. Minnesota, Illinois, Wisconsin are all part of 3 different types of electricity mixes. So what it'll do is it'll take the electricity mix and populate your carbon emissions based off of the scope 2 mix of electricity generation for that area. And it's sometimes surprising too. You might be surprised to know that, your carbon emissions, your historical carbon emissions are much lower in a location like Minnesota, for instance, because Minnesota gets 32, almost 33% of its electricity generation from wind sources. Wind being a obviously renewable energy source. So for facilities that are based in Minnesota, where you might have very high electricity bills, your carbon emissions may even be much lower than another facility that's located in Wisconsin, simply because that electricity mix in Minnesota includes 33% of electricity from wind. So this takes all of that data and populates it based off of every individual location's specific mix of generation electricity. The other additional, you can take, if you enter into or you purchase renewable energy certificates, then you can populate that offset of carbon emissions into the portal, and it'll show that to anybody who's requiring it. That will be part of the report. And so you start to get an idea of historical carbon emissions. You can start to look at some of the different technologies that I mentioned a minute ago. You might have a facility where you're looking at variable frequency drive motors and controls. Okay, so with the pro forma, so you go in, what we'll do typically is we'll go in with engineers, look at creating a pro forma, so cost analysis for the benefit, cost effectiveness of putting in VFDs with controls for different types of equipment. It might be sump pumps and chillers, anything that has a motor. So it might be a 2-year payback, but the additional payback is being able to show, okay, you have a 20% reduction in carbon emissions if you were to install VFDs at this facility also. So you can start to take different types of technology, whether it be VFDs, whether it be economizers and heat recovery systems, whether it be LEDs, whether it be solar, and that gets populated into this platform also, so that you can see not just what the cost effectiveness of including this in your capital improvement budget will be, but also show how much carbon that's going to reduce on a historical basis also. So where companies are starting to understand what it's going to, this gives you an idea. If you're looking at different projects and over time, and all these companies that are starting to make claims to a certain percentage of carbon reduction by 2025 or 2030, this platform allows you to see that in real time, understand the cost effectiveness and carbon reduction for different types of technology that you implement at different facilities, and what that looks like on an individual basis, but then across an entire asset portfolio, and how you can start to reach carbon reductions and metrics that are a 2025 metric or a 2030 metric. So this here is just another slide that shows populating this to this platform, cloud-based. You can start to break out all the facilities against each other and see that in tabular view, see it in line charts, see it in bar charts. You can see usage, you can see cost, you can compare and create a baseline, historical baseline, and then look at different time periods also, so that, you know, if you have done projects, let's say you put VFDs into, you know, retrofitted VFDs and controls at a facility somewhere in 2019, you'll be able to see the data from 2017 and start to compare that to the data after 2019 when all of that equipment was implemented. So in saying that, really we get to next steps. If you'd like for us to start looking at utility bills, you'd like for us to start engaging in conversation for carbon emissions benchmarking and give you a further look into some of that. We're happy to have an introductory conversation, look at usage analytics across different types of utility costs, energy assessments across these same utility costs, and provide some customized solutions, whether we're looking at different technologies that I was just showing a minute ago, or we're looking at using the cloud-based software platform to show historical benchmark of carbon emissions. This is something we focus on. That's part of our portfolio of consulting options, and we're happy to engage in conversation and look at some of those if you're interested. So with that, open it up for conversations. Thank you, Dan. Much appreciated. Dan's a veteran of these markets. I learn from Dan every day. He's a wealth of knowledge. Myself, I've been in renewable energy markets for 17 years, and we're excited to work with any of you, answer questions if you just have questions, and you know, very happy to be here and appreciate Jason the opportunity to speak today. I had a great time meeting a lot of you in Wisconsin Dells, and looking forward to seeing you again this year. And I'll let open it up to questions, and thank you.
I have a question. For the SEC for their Scope 3 operations, I just saw something come out in the news yesterday that they are pushing off the comment period to June 17th, and a lot of it has to come from the Farm Bureau. And on the ag side of the business, referencing there could possibly be a lot of the small farmers going out of business because of this, because of the increased cost it would be for them. What is your expectations as far as the ag side? How would they report their information as far as the SEC is concerned? Is it just by fuel consumption? Is it by hours of the tractor? And same with the fleet operation. Is it necessary to track do you have to track the mileage, or is it just a fuel consumption?
So far, what we understand and what we're tracking is, you know, we can do it by mileage. We can also do it by fuel consumption. I don't know specifically what's going to be required. Some of those details are still being worked out, and you know, there's a lot of, since the SEC announced this, there has been, you know, all sorts of groups pushing back. It's not totally clear which will be the standard. You know, speaking with some of our customers who have assets and facilities across the United States, there's no ability to put pressure to reduce carbon emissions. So it's going to be it's just going to be a reporting of carbon emissions, and how to do that cost effectively. You know, we feel like we've put together a platform that makes that cost effective, so it's not a huge burden, and that it can be populated on a monthly basis seamlessly. You don't have to go and upload anything unless it's in some cases, small municipal utilities are not online. You don't have access to your utility bills online. If it is something that's a physical, a manual input, like fleet fuel, right? It may be that you have different folks that have credit cards and they're using those to go fill up vehicles. That's going to be a little more of, tracking maybe mileage, but I don't have a complete answer for you which of those it's going to be, if it's going to be by gallon or if it's going to be by mileage. But from what we understand, the requirement is going to be, it's not there, it's going to have to be a basic requirement. It's not going to, there's no way they can make this complex and make it very, make it so it's so expensive that it's cost prohibitive for anybody to operate a business. And we're not here to say that we're happy about it. We don't feel like, it's hard enough to run a business, right? But what we've done is we've tried to simplify it and make it so that it's a relatively cheap platform, so that it does make it seamless, so that anybody can set up so that on a monthly basis, it can populate that data into the platform, so that anybody who's participating in the platform has a somewhere that's compiling it for them, and then and compiling it in a way that it shows all those different emissions, so that this person can then, or whomever at an organization, can hit a button that sends that report off to anybody who's requiring it. And I don't know, Mark, I hope I'm answering your question, and I don't mean to be wishy-washy, but I don't have all the answers yet, because it hasn't been completely worked through what the Securities and Exchange Commission is going to dictate.
No, I understand. So I guess my biggest question is on the ag, especially on the ag side. So my thought was that the way to do that would be on an annual basis on your annual fuel purchases. So that's really about the only way you can track an ag side, because you're not going to have a card for each tractor and each pickup that goes into the fuel tank to fill up. That'd be real cost, that'd be real cost prohibitive to do something like that. I mean, that'd be a big system. And so that's kind of what my thought process was for especially on the ag side of this, how to track the fuel. It's not the only way we can think of to do it.
Yeah, and I think, again, based off of the conversations we're having with different folks that are, and they're coming to us asking similar questions, and we don't have a good answer other than if you're able to, whatever data you have, if they're going to ask you to provide data, there's no way that they can audit something like fleet fuel data, right? So, whatever you're able to populate, and whatever you're able to show in a report, at this stage, that's the best that we can do. And then being able to provide the data that they're asking for around that input. So what types of different gases that they're requiring. So there are a few different types of gases that are going to be part of those numbers that are part of that input, whether that input be diesel or whether it be, just regular unleaded gasoline. Those different inputs are going to create a few different metrics that they're going to ask for. And so that we can create those metrics seamlessly without anybody having to do any math, and they can then provide that data to anybody who's asking for it.
Okay. That's my only question.
Okay. And I'll add, if there's any interest in a like a presentation along those lines, we're happy to put that together. We have a few decks around that greenhouse gas emissions, investor grade benchmarking and reporting platform that we can present to you and do our best to answer questions, but at least show you that these types of things exist, and it's cost effective also. It's not something that's going to break anybody's budget. We can make it so that it's cost effective, and that's really our goal. As Dan said earlier, we work with a lot of different associations. I go and meet with small businesses at conferences, and they have to provide and are being asked to provide this data already to some of the companies that they work with, and creating something that is going to be cost effective. As we're seeing price of everything increase, just adding something else to that cost of doing business is unacceptable right now. So we've done our best to make something that is accessible, easy, and cost effective.
Yeah, see, we've developed our own in-house greenhouse gas emission reporting system. But the problem is now it has to be third-party certified. We're gonna have to go outside and do it. So.
Right. Yeah, and that's part of why this is, why we have been putting this together and working with this and presenting it because it is easily third-party verifiable. So if you're ever part of an audit, it's easy to show that it can be verified and by any third party instantly.
Okay. All right.
Well, Michael, I appreciate you sharing about that tool. Aside from this recorded webinar that we'll share with our members, will there be some written material on that subject that we could share with our members as well?
Sure, we can definitely provide that.
That would be fantastic.
Yeah, more details. I had to condense it for the time period that we have right now, and we wanted to touch on some other things also, other technologies to be looking at, and get into some of those, because that's part of what we do as energy consultants. We look at every way you can, and this is what we've talked about. There are plenty of other ways that I didn't mention that we're happy to entertain, and we work with different vendors, and we really try to provide multiple cost analysis to different technologies, so that you're not just getting a bid from one company. You have, you're looking at ideas from multiple engineers, and work to reduce, costs of gas and electricity.
Well, we really appreciate you sharing this, Michael, and Dan as well, for just showing us the painful snapshots of where things are at regarding price. So no, I just want to thank both of you and APPI Energy for bringing this information and the potential solutions forward that can benefit our industry. So thank you guys both very much.
Well, thanks for letting us do it, Jason. We really appreciate it, and yeah, we'll certainly follow up with you for some written things. If we can, be of any assistance to you or any of your members, that's what we're here for. And even as Michael said, even if it's just a fresh set of eyes or a different perspective, we're certainly happy to do it. So thank you for having us again this morning.
All right, thank you guys. And thanks for those who are able to participate today.
Thanks all.
Right. Have a great day.
All right. Have a great day, everyone. Thank you.